Hello, everyone. Welcome to today's webinar about internal controls. Now, this particular webinar is near and dear to my heart because, as many of you know, not only am I the owner of Delegate CFO, I also own another company, HovlandForensic.com. And on that side of my companies, that's where I do my forensic investigations. So I investigate fraud, embezzlement, so on and so forth. And unfortunately, in that particular company, I've seen a lot of small businesses lose quite a bit of money. And mainly it was because of either lack of internal controls or not understanding internal controls. So the best forecast budget you could possibly have won't amount to anything if somebody's stealing from you. So that's why I felt it was important to go ahead and do this particular webinar to go over what internal controls are, what's the importance of them, what's the cost of not doing them, and then what you can do as a small business owner to have those in place. And again, internal controls are crucial for your small business because all the work you do could instantly evaporate from somebody just stealing from you. So let's go ahead and jump into the respective webinar. So again, we're going to talk about stopping fraud before it starts and the essentials of these particular internal controls. Again, my name is D Hovland. I'm a CPA as well as a certified forensic accountant. I've been a CPA since November of 2000, and I've been doing fraud investigations for almost 15 years now. And I've testified both in civil cases and criminal cases. And so today we're going to cover what are internal controls, why do they matter, and what's the impact that, say, poor internal controls can have on your particular company. So first off, I wanted to kind of give you some statistics from the Association of Certified Fraud Examiners. So why do internal controls matter? Well, if you want to know what the effect of fraud has on companies, Google Report to the Nations. Now, that's a report that's done every other year, so every 2 years, the ACFE puts out this report. It's a very detailed report. It's got very nice graphics, and it goes through every single fraud that you could possibly have, whether it's misappropriation of assets, which is more or less theft of cash, to inventory theft, to financial statement fraud. It breaks all that down. And then it breaks it down by respective regions, companies, male, female. So it breaks all that information down. It's very, very helpful. And it's very insightful when you go through and review that. But some of the statistics that are really applicable to our presentation today are here on the screen. From their report, 51% of fraud in small businesses is due to lack of internal controls or override of controls. And a lot of times the override of controls, you can just think that was lack of controls, because if somebody's ever able to override the controls, they're really not in place to begin with. So think about that. Over half of fraud happens because there's no controls in place. Small businesses lose on average 5% of annual revenue. Now that is a huge number, and I'll explain why. We'll walk through that particular 5% here in a second. But that's on average 5% of annual revenue to fraud. Median loss 120. Typical fraud lasts about 12 months before detection. Again, depending on that particular statistics, it depends on how long the employee's been with the company. Long-term employees, their fraud tends to go a lot longer before they're detected, but on average, it's about 12 months before detection. And internal controls are not just for big companies. They are for small businesses as well. So let's go take a closer look at that 5% of annual revenue. So right here on your screen, I took this from just a news article in Google. So if you have time, I suggest you go into Google, you type in bookkeeper fraud, hit enter, and there's be a whole bunch of stories, and there'll be quite a few stories. A month later, 2 months later, do the same thing. There's going to be a whole bunch of new stories. So this fraud happens quite a bit. So I just went in, typed in bookkeeper fraud, found this particular article, and this is actually a snippet from that article. And I'll read it verbatim for you because it'll have importance to what we're going to discuss. Said Janelle Klein, prosecutor for the Conference of District Attorneys, which represented the state in the case, some of the owners were using their own money to keep the business afloat and folks employed. believing the company wasn't profitable when all the while the problem was Ramos embezzling the funds. Now, keep that in mind. We'll come back to that screen, but let's keep that in mind. So again, on average, 5% of annual revenue is taken due to fraud. So let's do a real quick mathematical calculation so you kind of get an idea as to what this is. So on your screen, I just have a very generic company. Said they have $1 million in revenue, 600,000 in cost of goods sold, 350 in operating expense, net income $50,000. You'll notice that net income, the $50,000 represents 5% of revenue. So in other words, that 5% of revenue is 50,000, but it also happens to equal the net income. So most companies, especially small businesses, your net margin, which is your net income divided by revenue, it hovers around, say, 5 to 15%. Obviously, depending on your industry, you could have a larger percentage, but it's really the percent of net income divided into sales is your net margin. And in this particular situation, it's equal to 5%, the net income of 50,000. Well, that's 5% of revenue right there. And the more important thing to consider is when an employee steals from you, even though that previously slide said that it was 5% of revenue, a lot of times they're stealing your net income because at the end of the day, you still have to pay for your cost of goods sold. So you have to pay for your inventory. You still have to pay your operating expenses. So you got your rents, interest on your note, etc. You still, as an owner, have to pay that. So when they're stealing 5% of revenue, they're really stealing your net income on there. And another way to think about this is when somebody steals from you, again, they're more or less stealing from your net income. We've established that part. For you to recover those funds that they stolen, you have to have the amount of embezzlement divided by the net profit margin. In this case, 50,000 divided by 5%, it's going to be $1 million. So just to recover the amounts that they stole, you're going to have to recover or have additional sales on top of everything else of $1 million. So let's go back to our previously slide. Again, I won't read the whole thing, but where she said some of the owners were using their own money to keep their business afloat, believing the company wasn't profitable when all the while the problem was Ramos embezzling the funds. Again, that 5% of sales. In this particular situation, this Ramos lady, she was stealing from the net income. And I've seen this several times where owners of a company where they had embezzlement, they had to fund the company. They had to do a capital call or had to take out a line of credit. And so a lot of times they don't know that they're being stolen from. And again, like in this situation, this is not uncommon where the company thought they weren't profitable. In reality, it was just that lady was stealing the funds. And again, when you see that number, 5% of revenue, you need to think of it more of that's all the net, they're stealing from your net income. And however much they stole, I then need to take my profit margin and divide that into that respective number. And so going back to calculate, again, just to reiterate, to calculate the amount of revenue needed to recover stolen funds, you need to take the total funds embezzled and divide by your net profit margin. And again, embezzled funds divided by net profit margin. Key point here, if your net profit margin is lower than, say, standard, say it's 2%, then you're going to need to generate much more sales to make up for that cash investment. So conversely, obviously, if you have a very high net margin percentage, then you won't have to bring in as much sales, but you'll still have to bring in that. And when I'm saying bring in more sales, this is above and beyond what you're already budgeted. So in this, in our previous slide, we look at that, if this lady stole or this person stole $50,000 and that's their net margin is 5%. So obviously they need to generate $1 million just to make up that revenue. Let's say they already budgeted for the year for 2024, 1.5 million. So that means for them to get back to where they originally wanted to be at the end of 2024, they have to have 2.5 million in sales. And that's just to get to the cash basis that they were projecting to have. Because keep in mind, when you do your budgets in your cash flow, you're budgeting actual cash coming in to more or less pay for the company, pay for expenses, etc. Again, goes back to this slide. Company wasn't believing they were profitable. Again, she's stealing from the bottom line. So that is a key point to understand is when you see something like statistics of 5% revenue, that lady or those people are stealing from your respective bottom line. So fraud. Now, you'll hear the term fraud triangle. So if you go into Google or type in fraud triangle, you'll actually see all sorts of images of literally triangle. And what the premise of the fraud triangle is you need all three sides of the triangle to have fraud happen. A lot of times when you see the picture, you'll see the pyramid, and then you'll see fraud stuck in the middle. A better way to think about it is instead of a triangle, think of it as a three-legged stool. So in order to get, and if we say the seat itself is actual fraud. So in other words, to have fraud happen, we need those three legs. And the three legs of a fraud triangle or three-legged stool are motivation, pressure, rationalization, and perceived opportunity. Now, you'll hear different descriptions of it, but these are really the three key areas. Motivation and pressure. That is usually when somebody feels like, they have a lot of medical bills, so they need to get those covered, or, they want to stay at the country club with all their friends, but it's very expensive, but they don't want to be on the outs with all their friends there at the country club, or, all their friends are going to Vegas, once a quarter, and so they feel like they want to go to that. There's usually some sort of motivation or pressure behind somebody who commits fraud. There's something there that's causing them to want to do that. Rationalization. Rationalization is predominantly if I'm an employee and I feel like I worked a ton for the company, but they didn't give me a bonus. Well, I may rationalize I deserve a bonus because I work harder than so and so, or I deserve a pay raise because I'm actually doing two jobs, when so and so left. So rationalization is how somebody rationalizes they should commit fraud because of XYZ instance. And the last item, perceived opportunity. Now, perceived opportunity is where this is where you have internal controls. If I'm a scrupulous person and I'm trying to steal, and I know that the owner never looks at the bank statements, never looks at the income statement, just occasionally shows up, writes himself a check for disbursement. He's not really there. Nobody really looks over that. In my mind, if I'm committing fraud, I see there's an opportunity here because nobody's going to catch me. Nobody's looking at my work or anything like that. And so that's really where the internal controls are. So back to the three-legged stool. You need all three of these items to have fraud happen. Now, you can't control the motivation and pressure. Somebody's wanting to be at the country club with their friends. You can't control that. Rationalization. Now, you can talk to an employee about how great and valuable they are, but you can't control how they're rationalizing, hey, I should have a bonus or I should get paid more than so-and-so type situation. You can't control that. But you can control perceived opportunity, and that is your internal controls. So if you control that perceived opportunity, you more or less have removed that leg on a three-legged stool, and what happens? It falls over. And then you don't have fraud happen. And so that's why it's key, even then when we talk about fraud triangle, I can think of it as a stool, and the one area that you can definitely control is the perceived opportunity. So let's get into the main basis or the main foundation for internal controls. So a lot of you have probably heard that with internal controls, you have what's called segregation of duties. And segregation of duties is really broken down into four main areas: authorization, custody, recording, and monitoring. Now, authorization, just like the name says, that's the ability to authorize a transaction, whether it's authorized to sign the check or authorized to do a purchase agreement or purchase product from a vendor. You have some sort of ability to authorize a particular transaction or even sign a lease agreement. Custody of assets. Again, 20 years ago, this was predominantly centered around who has custody of the actual checkbook. But today, it's really who has access to the bank statement, electronic funds, or EFTA funds, who has access to the actual physical documents, who has access to by physical documents, meaning the actual checks, and who collects payments. That's an asset. So who has custody of these particular assets? Recording, again, who records the transaction into the accounting records, into QuickBooks Zero, what have you. Who does the actual recording of the transaction in there? And then monitoring. Monitoring is where you're reviewing all the processes, reviewing that transaction. Is this transaction correct? Reviewing that journal entry. You're monitoring and or reviewing the bank reconciliation. So you're performing a review level. You're not doing all these particular steps, but you're going back and reviewing all that. Now, of all these duties, let me take a step back. In the textbooks that you see in college, they always say that you have one person in each one of these areas. One person does authorization, another person has custody, recording, monitoring. In the real world, that's not feasible for small and medium businesses. You can't afford to have literally one person in every single area. As a small and medium business, a lot of times some of these duties are intertwined with the same person. However, as the owner, executive management of your company, that monitoring function should never leave your grasp. You should be the one that does that, not only has that ability to do it, but you should be doing it consistently. Because most frauds that you see, again, if you go and type in bookkeeper fraud, if you read those stories, one, I suggest you look at this particular slide when you read those stories to see, okay, who had authorization, who had custody, etc. But the monitoring is usually why that fraud happened, because the controls were not being monitored, cash wasn't being reviewed, bank statements weren't being reviewed. And so of all these controls, that monitoring function should stay with you, the owner or executive management. Now, again, like we just mentioned, if one person has access to all four areas of the segregation of duties, then the business will be ripe for fraud. Again, go back, do your Google search. Oh, I can almost guarantee every single one of those, there was a situation where that person had access to all four, or they had access to three, but the monitoring was never being done by the other person. So de facto, they had access to all four. So if somebody has access to all four of those items, you are heavily ripe for fraud in your organization. So what are internal controls? Internal controls really are going to be your policies, procedures, and systems that you have to protect your assets. One way to think about it, and and I've done presentations before for businesses that are going through incubation centers, is imagine if you took your wallet. Let's say you have $500 cash in there, you got several credit cards in there. Would you take your wallet if you're like in a classroom setting, put it down on a desk, walk away for a couple hours, and then come back and expect all your cash to be there and your wallet to be there? Probably not, and you probably wouldn't do that. That's the same thing that happens with your business when you don't have controls in place. You're really doing that. And so back to what are internal controls? They're really policies, procedures designed to protect your assets. They're designed to prevent or detect and respond to errors or fraud. And errors do happen. So don't, anytime something is out of whack, don't immediately assume fraud, because sometimes we're all human. So we, could mispost something. The key elements obviously are the segregation of duties, authorization process, checks and balances. So back to that first bullet point, policies, procedures. You want to make sure you detail out that, because a lot of times what you'll find is if you have to write out a memo saying, this is what this person does, this is what that person does, you start realizing, oh, Jane actually has access to all these areas. And you don't really realize that until you start printing it out. But when you put those policies and procedures in place, you then set up the structure for your company, because all companies have turnover, even in your county department. People retire, leave to another job, termination, what have you. When you bring that other person in, you want to have those policies and procedures in place to be able to identify it, or be able to have them know what their control processes are. And just a side note, on my forensic side of my company, when I do an investigation, one of the first things I do, I mean, obviously there was an incident that happened for, the particular companies to give me a call to begin with. But one thing I'll do is I will just sit down with them and I'll just document what their controls are in just a memo form. Reason being is that will then lead me to understand, okay, there's a weakness here. Jane had access to the cash, didn't, no bank recs were done. Nobody monitored that. So I'm looking at cash. Whereas, Fred may be doing the payroll, but Jane was HR and she did the payroll rates, but Fred just did the payroll. I might not be as concerned on ghost employees on that situation. So writing it out will help you identify where your weaknesses are, and then you can from there start molding what your controls need to be. Now, what is the cost of doing nothing? Obviously, as we already noted, lost net income. People steal from you, they're going to steal from your bottom line. So right there, there's lost net income. The other cost, attorney fees. So you catch somebody committing fraud, odds are you're probably going to go after them civilly. Hopefully, you also go after a criminal, and we'll talk about that in a second. But if you're going after civilly, you're going to need to go and get an attorney, preferably one that can do litigation, and you're going to have costs for the attorney fees. Forensic accountant, you're going to have to pay for an expert to go through because if you go to court, obviously civil, you need to have some sort of report indicating here's the total amount of funds that were stolen. This is how she did it. This is, over this time span, et cetera, et cetera. So you have to pay for a forensic accountant to go through there. So those are all just actual monetary fees. Now you've got your own time spent on investigation, meetings, court days. You've got to meet with the attorney to go through it. So that's time out of your day. You've got to meet with, if you're doing criminal, you've got to go down to the police department and meet with the detective. So that's time out of your day. You go to court, both civil and criminal, you're probably going to be in court for a while. So all that takes up time, not only the actual meetings themselves, but a lot of times you have to prep for those meetings. And so you're going to have that as well. So all that is just your own personal time that you could be spent working on the company. You're now being spent on doing this. Possible lost revenue and opportunities. Obviously, lost revenue could be if the bookkeeper was stealing accounts receivable and you call up your best customer and ask them why they haven't paid. And in reality, they actually had paid and you just alienated your best customer and they might not do business with you again. So, there's always that possibility. And then of course, opportunities. If they're stealing from you again, they're stealing your net income. So you don't have that extra cash to, expand your warehouse to be able to offer more products or quantity of product, or hire that next programmer to come in for your SaaS company. You're going to lose those opportunities because you just don't have the cash to be able to do that. Personal assets. Now, I've seen this a number of times. If you recall back on our previous slide, let's go back to that real quick on that quote where it said, believing the company was profitable when all the while the problem was Ramos embezzling funds. The owners were putting their own personal money in there. I have seen a number of times where a particular owner has had to sell their own personal assets to keep their company going. They believed their company was failing. They didn't want it to fail, so they had some investment assets. I believe other rentals that they ended up selling. I think one guy ended up selling his boat, selling a car, so that then they had the funds to keep their company afloat. And again, this is all because a fraud happened. In this particular situation, this individual, this owner had this personal asset in the family for quite some time. He ended up having to sell it. And he shouldn't have had to sell it because this lady had stolen from him. And recovery is highly unlikely. This is part of the cost of doing nothing. Most of the time, from what I've seen, is when an employee embezzles, there's a particular employee embezzlement, they usually use the money on items that aren't tangible. And by that, I mean, they'll take a trip to Italy. They'll go on a Caribbean cruise. They'll go to Vegas and gamble a whole bunch. So they're using all that money, but they're not buying physical assets. It's not like they're buying Bitcoin or real estate. They're just using it and blowing it on stuff that can never be recovered. And then conversely, if they do buy an asset, oddly enough, they don't take good care of that asset. So I've seen situations where individuals bought, either high-end pickup trucks or luxury cars, and they just didn't take care of it. It was just all beat up by the time we got to the fraud and collection standpoint. And just based on the small sample I've seen, for some reason, when people commit fraud and they buy a personal asset, I believe it's probably because they didn't have to earn the money to get that asset, so they don't care for the asset as well as most people would. So that's one of the things to keep in mind. Again, they may have bought a physical asset, but it's probably all torn up. So recovering of what they stole is very highly unlikely. Again, you can get a judgment and start collecting, but how much you're going to collect and how long that period is, that's going to be up in the air. One thing I will add to this, it's not on the slide. Usually when you catch somebody committing fraud, embezzlement, they will only admit to what they think you know. And I've seen statistics that usually, whatever they tell you, you need to multiply that by, I believe it was like 5 or 6, because they're not going to admit to the full amount. They're only going to admit to what they think that they stole. The other aspect is, and I've seen this before, sometimes they didn't even know how much they stole. I had one case where an individual had been stealing from this company for at least 12 years, probably more. We didn't have enough records to go back any further. And it was multiple transactions each month. Sometimes one month it would be a couple transactions. Sometimes, it'd be up to, 14 transactions in a month. So this happened over years and years and years. And one of the things I had informed the detective, because this was going through criminal, is this individual probably doesn't even know how much they stole. And again, same thing is they blew a lot of it on stuff that wasn't tangible. So the owner is probably not going to collect, or is going to collect pennies on the dollar. So again, this is all the cost of not doing anything with your respective internal controls. Now, excuse me, core internal controls every small business needs, and actually every business, but in particular small businesses, bank reconciliations, they need to be done and done timely. I actually had a case once where it was a bookkeeper for kind of a smallish company. And again, they didn't monitor her. She ended up, she was committing embezzlement, but she had never done a bank rec. And they never said anything. And we came in and weren't doing a fraud investigation. We were just doing a financial statement audit. And we could never get the bank rec. And apparently this has been going on for years. And finally we got the bank rec and there were all these errors in it. And, we just kept asking why there are errors. And again, that's eventually where it fell out that there was embezzlement. But if she had been doing the bank rec or, been doing the bank rec and timely and it had been monitored, this would have all been caught pretty quick. Again, unfortunately, this was one of those situations that it's not uncommon that the ownership terminated her. I think they went after her civilly, but they didn't press criminal charges. And that's not uncommon when criminal charges aren't filed. Again, that's due to reputation risk. They don't, the company doesn't want to be in the local paper, all that. My recommendation, especially when I take on a new client or a new forensic case, is that you prosecute. If there is obviously fraud there, that you move it to the criminal aspect. Because if you don't, person's going to do it again. And with all how HR rules are, I believe you can't tell, the new employer that you fired, Susie because she committed fraud. So unless there was a criminal charge. So that's why I always say, if you're going to do it, make sure you file criminally. So other internal control, mini audits done monthly. So for our CFO clients, we do mini audits every month regardless. And what a mini audit is you take the balance sheet and you tie out each of those accounts to source documents. So again, cash is going to be the first line item of your balance sheet, should tie out to your bank statement and your bank reconciliation. That should work. Accounts receivable, that should tie out your AR subsidiary ledger. Those two should tie back and forth. Obviously, review your AR subsidiary ledger, make sure there's old stuff on there that, isn't suspect. And you go through that. So everything is getting tied out. And this is actually what we did for we had a client that was a small not-for-profit that had hired a lady to be the controller, but she really didn't have controller experience. And so this is literally what we had her do each month was a mini audit. And by that is, she just had an old physical binder. She'd print out the trial balance, had each of the things, so the bank rec would be first item right behind the trial balance, and then she'd have her AR subsidiary right behind it. So everything was supported. So she was doing this mini audit every month. And again, when you do that, if any kind of fraud is happening and being hidden on the balance sheet, it's going to fall out very quickly. Physical security of assets, including electronics. And by electronic, what I'm talking about is bank statement and in particular wires, ACHs, those type things. Dual authorization for payments. Again, for certain levels, a lot of companies require dual authorization, and especially on wires. That should have a dual authorization on there that the person initiates it and it can't go through until the owner comes in and signs off as well. And budget to actual, and as you see there, hint, this is extremely important. Obviously, you need to have a budget in place. And if you need help with budget, give us a call. We'll help you put a budget together for your company. But every month you need to do a budget to actual, because a lot of times that is one of those monitoring functions that a weakness will pop out very quickly. Because let's say office supplies, let's say you budgeted 20,000 for the year for office supplies. We're in June and you're already at 30,000. So you have a 10,000 delta and you're only halfway through the year. That's going to spark your interest. You're going to dig down further and find out, okay, why we put 30,000 in there when we only budgeted 20 for the entire year? And so then that becomes one of your monitoring control functions. And again, this is huge for internal controls. If you go back and look at a lot of the videos on Elon Musk when he was doing the Doge issues, one of the things he noted in one of his interviews was the lack of budgets in some of those federal departments. Well, if you don't have a budget, how do you know you're going to be over budget, under budget, expenses authorized if you're not being able to compare it to something? So that's why we say budget to actual is extremely important control with your small business. So how do you implement this? Again, assign responsibilities so no one person handles a transaction from start to finish. Again, segregation of duties, those 4 areas, that one person should not have access to all 4 areas. Use accounting software, permission settings, and logins. And you'll see that logins is underlined. First, the permissions. Obviously, you have an AP clerk, they really should have no reason to have access to AR, or the AR clerk shouldn't have access to AP. So you obviously set up the permissions correctly. The other aspect is logins. Now, unfortunately, with QuickBooks, the standard login user ID is admin. That becomes a problem when there's fraud that happens, because as a forensic accountant trying to prove that John was the one that stole this money, it becomes a little difficult because you go into the transaction and see who posted it, and it just says admin. And so defense will come back and say, well, anyone could have done that, it's admin. So that's why your logins need to be specific to that individual. So John has his own admin, Susie has her own login, sorry, not admin, login, and all those transactions are tagged with that respective information. And so that's why it's key that you put those names in there. Again, if you just do admin, it makes it more difficult to prove that respective fraud. Now, there's workarounds for it, but it makes life so much easier if you can go in and see that, John went and modified this transaction at 6 p.m., when the company closes at 5, and here's his login, here's the timestamp type situation. So that's why you want to make sure that each person has their own specific login to their name, and make sure nobody knows anyone else's login and passwords. Those passwords should remain with your IT. If you don't have an IT department, HR, just make sure HR doesn't have access to the accounting records, and then you'll have controls there. Because I have seen situations where an individual that was committing embezzlement had access to other logins and was using those logins to further their investment. Require management approval for purchases over a certain dollar amount. Again, you need to obviously, set the dollar amount, but if the purchasing manager, is making $150 supply purchase, you probably don't need to have manager approval on that now. It's 150,000, yes. So you need to determine what approval level you need that one doesn't hinder the business, but two provides control for your company. Again, can't stress this enough. Review the bank statements monthly. And by bank statements, I also mean the bank reconciliation. If you don't know how to do a bank reconciliation or what it's telling you, there are a number of videos there, or you can even contact us because it's very important you understand what's going in and out and how that bank reconciliation works. Now, maybe if you've never done one before, maybe kind of a struggle the first month or two, but once you understand it, it'll be very quick and easy for you to be able to review that. But again, if you're not reviewing that, it's going to be very hard to catch fraud because keep in mind, almost everything in your financial statements pivots around the bank account. If you think about that, that's going to be your cornerstone for pretty much everything else within the financial statement. So you need to make sure that number is correct and tied out and understood before you start breaking down everything else. Inventory counts, obviously, do surprise the schedule if you have valuable inventory that could be stolen. Again, surprised ones are key. You should be doing schedule counts regardless of this. Because you need to understand what your order point is, how much you need to order, et cetera, et cetera. But if you've got valuable inventory, you need to make sure you're doing those counts on a surprise basis. And if you want to see something rather impressive, if you look up one of the diamond companies like Debris, you look at them and look up their controls. I won't go over them, but they're just like, because a diamond is highly valuable and teeny tiny, they have very, very specific controls, and it's just eye-opening. And it makes sense, but it's just eye-opening when you read those controls. Now, red flags, warning signs, again, unexplained cash shortages. Back to that quote we had in that story. The company, the owners thought they weren't making money, so they had to put cash in. Unexplained cash shortages hit. And again, this also goes back to your budget, because when you're budgeting and most people are budgeting their income statement. If you're not hitting those budgets, obviously that's going to impact cash. And that's another budget to actual that you'll have is, okay, this is what I expect my cash runway to be. And why did that runway all of a sudden go from, say, 18 months, now it's retracted to 12 months. And again, that's going to be part of your monitoring function, but any unexplained cash shortages that require, oh man, I need to put in cash now, that needs to be a red flag. Now, one caveat to that, if you're in an industry that all of a sudden your sales are just rocketing up, you get into that weird situation where you have a ton of sales, but because of collection procedures, you may sell to, say, Walmart or whoever, and so your sales have gone from, say, 10 million, now you're up to 15 million, and it's just rocketing up, but you don't collect on those sales until later, but you've got to pay for all the expenses up front. And so you wind up in kind of a weird cash shortage situation. So that is a situation where you do wind up in cash shortage. And it's not internal control, it is just because of the projection of your business. But you still need to be able to explain cash shortages. Excessive voids or credits. Again, obviously, if somebody's voiding transactions, they may be pocketing cash. Again, this goes back into cash shortages. Budget to actual fluctuations. Again, we've gone through that. Missing documents. That's obviously a red flag. If you have a vendor invoice that, you paid the vendor invoice, but just so happens that particular vendor you can't find the invoice for, but you have the invoice for everybody else. That's a huge red flag. Employees who never take time off. Now, this is mainly centered around the accounting staff or also inventory personnel. The reason why they don't take time off, because they know that their fraud has gotten to a point that if they do, it's going to unravel or it's going to be discovered fairly quickly. And again, another way around this for those employees that commit fraud, they may take time off, but they make a big show of, well, don't let so-and-so into the records because they're just going to mess it up and it'll take me forever. So I'll fix that when I get back, or I'll keep doing the accounting. I'm going to be gone for 2 weeks, but I'll keep doing the accounting when I get back. Don't let John into the records. That's a way they get around that, not taking time off because they want to take time off, but they also don't want you to discover the fraud. But if you have employees that aren't taking time off, that's a huge red flag. Now, I will admit I did have a situation where this individual didn't take time off for years and years and years. And it came about that they were actually using their PTO as kind of a retirement vehicle. Because if you think about it, if you have, say, 80 hours of PTO, each year you get a raise. Let's say you get 5% raise. Well, you're making 5% on that 80 hours that you had banked, several years ago. And then she was also getting more hours, so it was adding on to that. So it just compounded. And so her PTO, I think, got up to like $50,000. We ended up fixing that situation, but that was one of the rare times where somebody didn't take time off, and it was strictly because of they were using it as another aspect for the retirement. And vendors with similar addresses and employees, obviously you do not expect a vendor to literally have the same address and employees. The other thing to keep in mind is you want to, and this is kind of back end control, review your vendor list at least quarterly. Just print it out and go through it. Reason being is there's another type of fraud that is external fraud that can hit you. So if, let's say, you're doing business with ABC company, and that was like 3 years ago, you haven't done business with them, but they're set up in your system, there could be an unscrupulous person at ABC that says, well, I'm going to send an invoice to them and see if they'll actually pay it. And that actually does happen. Actually, I think it happened to a very large company like IBM or one of them, where a vendor just sent an invoice just to see if the company would pay it. And so that's an external fraud. Now, the internal fraud is where you have, let's say you have ABC, and let's say it's called ABC Company. And then somebody goes in and makes ABC Companies and puts an S at the end. They intentionally misspell it. You as a owner, maybe signing checks, you just see it, you don't catch that, there's an extra S on it. Just sign the check, send it out. In the meantime, that employee has just set up a fake bank account to cash it. So it says ABC's company, and then they pocket the cash. So again, you want to review your vendor list to make sure there's not any unusual there's not unusual vendors, and two, any vendors you haven't done business with, you want to either terminate or discontinue that vendor in the system so that if a fake invoice comes from them, it's immediately going to pop up and everybody's going to take a second to take a look at that. So let's go ahead and go into our Q&A. Let's take a look here. So we've got several questions here. So we'll go ahead and take a look at some of these questions. Give me 1 second. Okay, so these are pretty good questions here. So a 3-person office, let me move this. 3-person office, net 120 clients. How do I make no one has time compatible with segregation of duties? Again, first thing is somebody steals from you, you're going to steal from your bottom line. So that's one of the keys. But you need to make sure that the monitoring function is separate from all the other. If you're a 3-person office, my guess is you're having to have people do multiple tasks in multiple areas. You just need to make sure you mitigate that by taking the monitoring function, and that is with the ownership, executive management. Don't let, if you're just using one of those people, don't let them do all of it. And again, that quote of no one has time, you still have to get your, billings done, bills paid, income in type situation. So you still have that has to go on. So just make sure that that monitoring function stays outside the purview of the individuals, which is probably going to be doing multiple areas of the segregation issue. If the CPA who does our taxes is also our outsourced CFO, does that satisfy independent review, or do we need a different set of eyes on the bank rec? Well, first, yes, that satisfies the independent review. they're really going to be producing and doing the bank rec. And I'm assuming they are the ones doing it, or they're reviewing it, the bookkeeper's doing it, and they're coming in and reviewing it. So that is a key control right there. However, I still recommend that you understand what it is they're reviewing, how they reviewed it, and they go over that with you. Because this is your company and you really want to understand this. And if for some reason you expand and you become a larger company and all of a sudden you need an actual on-site CFO, you can't do the outsourcing anymore because it's just the sheer volume of everything that's going through. You want to be able to understand those bank reconciliations. So yes, it is good that they're doing that review and it's independent, but you still want them to go through and train you on what this is and what they're looking at. We file taxes cash basis, but someone told me that gives embezzlers extra months to cover the theft. Should we switch to accrual just for internal reporting, even if we stay cash basis for the IRS? So there's a couple things in that particular question. First, you should always be accrual basis. Obviously, if you file your taxes cash basis, if you go into QuickBooks, literally at the top, when we print out the balance sheet, it has, you can click the button cash or click the button accrual. You always want to be accrual because technically a true cash basis person would never have accounts receivable if you went to the true cash basis. Now you'll have tax accountants out there say, well, we do a hybrid. That's just accountant speak for we're cherry picking the accounts that we want to recognize, i.e. AR, but we don't want to do accrual payroll type situation. So being accrual basis is, first the key. And then the other part to your question about someone told me it gives embezzlers extra months to cover the theft. If you're not reviewing, or actually there's two aspects. One, your tax accountant will not catch fraud. Tax accounting is not designed to catch fraud. If you think about it at its core level, a tax accountant does data entry. They take your data, they put it in the tax software. Now, they have to understand where it should go, what is and isn't deductible, so on and so forth. But for the most part, they're doing data entry. They're not going through and reviewing it. Now, if they happen to find fraud, it's probably because they happen to stumble upon it, but they're not looking for it, and they don't have tests designed to look for it. So that's also important to note that even though you have a tax account, they rarely will identify fraud and find fraud. But the other aspect to that, where you mentioned gives embezzlers extra months to cover the theft, you need to be doing your monitoring monthly. You can't do it at the end of the year. Because again, if you remember that slide we saw at the beginning, the average fraud isn't detected for 12 months. In this situation, if they happen to commit fraud in January, that would literally be 12 months of fraud going on without being detected. So you've got to do your controls every single month. Again, controls break down to doing your mini audit, looking at your bank recs, looking at your budget actuals. You've got to do that monthly. Once you start doing that monthly, again, it gets easier. And again, all this control stuff that I'm mentioning, this is what our CFO company does for our clients. And I believe we're one of the few, if not the only company that has forensic accounting as part of our CFO package. And then running out of time, so the last question was just one more here. Lease a copier or buy one outright. The rep claims lease auto bills quarterly and nobody checks. Could that be a place to bury a fraudulent vendor? Yes, you could bury a fraudulent vendor. However, it would be caught if you're doing your budget to actual. This is actually a good thing to discuss on budget to actual. With your lease or any lease, you pretty much know what your payments are going to be. So that budgeting part is pretty easy. It's like a $1,000 a month lease payment, or in this case, it's quarterly. I got $5,000 every quarter that I have to pay. If your company buys the copier or outright purchase it, then all of a sudden you see a lease payment, that's going to show up instantly like a red flag. Because when you get to that end of Q1 where the payment comes out, you're going to look and see, okay, here's this lease payment for $5,000 and I have a budget of 0. Why is that? then you're going to go ahead and dig into that respective item. Hopefully you'll see, okay, why did we just pay the copier lease company of 5,000 when we actually bought this? And then you start going down the road. Now, there may be kickbacks on the other side of that. Who knows what the other aspect of that is? Because when employees commit fraud, they want the cash out of the company. So you got to think, how are they going to benefit from this? Um, Usually in this situation, if it goes to the copy machine or copy company or machine copier company, it would probably come back as a kickback. So again, budget to actual is really key on this respective aspect. Uh, so again, we're running out of time, so we'll just kind of jump to the second last slides. Again, if you need help with any of this, please feel free to book a complimentary internal control consultation with us. We'll go through that, and just we can pretty quickly identify what your weaknesses are. Now, a full internal control review will take a little bit longer, but we can at least do a quick phone call and get an idea as to where your weaknesses may or may not be in respect to the operations of your company. Again, my name is Steve Hovland. I'm a CPA and I'm founder of Delegate CFO. You can reach me at steve@delegatecfo.com. You can learn more about our company at delegatecfo.com. And this is currently being recorded for those of you on live. The recording will be distributed out to you afterwards, as well as the respective materials. And also one aspect that isn't here is we will be sending everyone a quick internal control checklist. It's very small, it's like 2 pages, and it just gives you an idea as to, do you have weaknesses currently in your system? And it's pretty much a yes, no as you go through. And if you hit certain barometers, it's going to kick out and say, yeah, you probably need to review your internal control. So we'll have that to the people who are watching currently on live. If you're watching this on a recording, please feel free to contact me again, Steve at Delegate CFO, and I can go ahead and get that sent out to you as soon as I can. So again, thank you for taking the time to watch this, and I hope you have a great day.